Barron's Roundtable, sponsored by Global X ETFs.
Welcome to Barron's Roundtable, where we get behind the headlines and prepare you for the week ahead. I'm Jack Otter. Coming up, stocks hitting record highs this year. Investment strategist Liz Ann Saunders on why Fed Chair Jerome Powell may be dancing with joy. And later, AI is dominating Wall Street, but there's money to be made elsewhere. Barron's mid-year roundtable looked at some alternatives if the big tech plays become a bust. But we begin with our expert panel and three things investors ought to be thinking about right now. On the Barron's Roundtable, my colleagues Andrew Berry, Rebecca Ungarino, and Jacob Sonnenschein. So, Andrew, the market did very well this week after that report came out on Thursday, suggesting that inflation continues to moderate.
Yeah, that was the big news. June consumer prices were down 0.1%. The consensus had been for an increase of 0.1%, continued moderation of inflation, now running about 3% year over year, and actually a lower rate than that over the past 6 months. So that key to rally in stocks and bonds.
Of course, when you look into the numbers, there was some good news, some bad news on inflation. Break that down for us.
Well, I tell you, the big increase that you continue to see, and many people are Americans are feeling that, is auto insurance up about 20% year over year. And, you know, for instance, like I just got my auto renewal, I'm paying 10% more. I guess I feel a bit lucky it's not 20, but I'm paying about over $6,000 a year to insure 2 cars in New Jersey.
Back to the market, an interesting thing, a change in leadership.
Yeah, I mean, you saw basically, the long-awaited rotation that into smaller stocks occurred this week. They had been lagging dramatically, about flat this year coming into this week versus the S&P 500 up around over 15. This week you saw a big move in small stocks. The Russell 2000 index gained about 6%, mid-cap up around 5%, and the S&P 500, while it intraday hit a high on Friday, finished below its record high, up only less than 1%. The Dow actually finished at exactly 40,000, up over 1%.
That's rare. Now, of course, with the smaller companies, they have more trouble with paying off debt than the Mag 7 that are actually, making money on interest. Do you think that the bond yields will continue to come down?
Bond yields could continue to come down. I think you could be looking at 2 to 3 rate cuts by the Federal Reserve this year, which would take the key short-term rate below 5% by the end of the year. And that's keying, small cap stocks, which are cheap relative to large cap stocks and been rarely this inexpensive on a price basis.
And good news for consumers.
Yeah.
So, Rebecca, you're looking at the consumer world in terms of, we had bank earnings this week. What did you see?
So it was a real kind of divergence that you're seeing. Now, Wells Fargo, JPM, and Citi all reported today second quarter earnings, and they were all real laggards on the day. They've been really strong so far this year. They have been outperforming all of them but Wells. They were outperforming the market so far this year. Today, you saw Wells, one of the worst days in a few years. JP Morgan finished the day, I think, around 1% down, Citi down. But the top line was great. They were earnings beats, but you saw some softness you see really, really strong investment banking results from a low base from last year. But you're seeing that softness in the consumer. I think, you're mentioning auto loans. All 3 CFOs, Wells Fargo, Citi, and JPM, all pointed out, and this is reflected in their balance sheet, that the consumer, you are seeing cracks in the lower end of the consumer. A lot of the high end is driving most of that consumer spending. So overall, investors were not impressed by these results.
Still, lousy day on Friday, but if you pull back the lens to the week, the KBE was up 7.5%. You look at the year, banks have had a great rally. What's driving that longer-term positivity?
Totally. Some analysts were saying today that, it is a little bit of investors taking some chips off the table because, of course, they've been real, strong players so far this year. The regulatory backdrop, as well as the interest rate, the direction where the Fed is headed is favorable for the banks. That didn't really do a lot for them today, but overall, investors have sent them higher this year because of more favorable regulatory environment, as well as the Fed set to cut.
And you're also seeing, concerns on Wall Street about the consumer. Pepsi reported this past week, and it was kind of weakish. You're not seeing much volume growth there at Pepsi. One of the problems that consumer companies are having is pricing. They've been raising prices dramatically. Pepsi, for instance, is prices were up about 10% last year, about 5% this year. It means that like a pack of Cheetos, which are my favorite, cost about $6 for about 8 ounces. It means about $12 a pound. So that's out of reach of some consumers.
So if you like Cheetos, you should go to Costco. Jacob, you're looking at Costco, which raised its membership rate this past week. Stock fell. What's going on there?
Finally, after a period of years, about 7 years, Costco was able to raise their membership fee by about 8%. That actually matters a little bit because they have a very high profit margin on that fee revenue, so it flows through really nicely to earnings.
Got a lot of upgrades.
It got a lot of upgrades. The issue with the stock, and by the way, comp sales year over year are up 6% because they keep getting a few million more members every year, and so they're able to grow. They don't even have 100 million members yet. We're in a really big country, United States, so you can still grow from here. And part of their brand is being that value-oriented provider in an inflationary environment. No wonder their comp sales are up 6% year over year. Stock was down because it was up 50% since the October low.
And it's a pretty pricey stock, about 50 times earnings. You think that's justified?
You're looking for about 12% earnings per share growth. Usually in this market, you are not getting a 50 times forward PE multiple for that kind of growth. The reason you're getting it with Costco is because you expect the growth to be pretty durable long term. Hold the stock. I wouldn't buy it at this level.
All righty. Thanks, Jacob. Stocks surging to record highs this year, but where should investors be looking for maximum opportunity? Charles Schwab investment strategist Liz Ann Saunders explains what kind of stocks are leading the market higher, and it's not the Mag 7. Next. This week's inflation report increased the odds of a Fed rate cut in the coming months. My guest says that even though the market is having a great year, many stocks have actually experienced their own little bear markets. Joining me now is Charles Schwab Chief Investment Strategist Liz Ann Saunders. Liz Ann, great to see you again.
You too, Jack. Nice to see you.
So let's start with the CPI data on Thursday. You said the Fed might be dancing the jig based on those numbers. What was most interesting to you?
Well, it was pretty much across the board a better report. The headline was better than expected. The core, which is ex-food and energy, was better than expected. Most of the component parts, in particular the rent component of CPI, and then an imputed version of that called owner's equivalent rent, really has started to come down, and that has been one of the stickier areas. So it was pretty much across the board stronger than expected. And on the same day, we got better than expected unemployment claims readings too. So that brings both of the Fed's mandates of their dual mandate into sharper focus. And it was just a Goldilocks kind of day.
And in response, investors bid up stocks. All stocks, including small caps and others that haven't been doing very well. Is it time to jump into that area?
Well, I think you still have to stay up in quality. I think the reaction day to this better CPI report, everything that hadn't been working worked that day. And there was a little bit of a lower quality bias to what worked. But I would say that beyond just the very, very short term, if you're looking for opportunities amid the under the surface weakness and rotation that has happened, you still want to stay up in quality. So looking for companies, stocks of companies that have strong balance sheets, that have ample interest coverage, that have strong free cash flow, that have profitability. So that's the way to approach the market when you're moving away from just what had been the small handful of names lifting performance to such a degree.
So that's a point you've been hammering home, and maybe you can explain that a little more for viewers. So everybody thinks the Mag 7 have been the ones driving performance, but it's actually those quality stocks, and you've pointed out that the dispersion between the performance of those really high quality stocks and the lower quality has been enormous.
Right. So I think there's some conflating that happens when we talk about, let's use the Magnificent Seven as a group because it's got so much popularity, that they are the biggest drivers of performance for the cap-weighted indexes like the S&P 500 or like the NASDAQ. But it's not solely because of their price appreciation. It's price appreciation times their market cap, which means they're 7 of the largest contributors to performance. But they're not the 7 best performing stocks. The top 10 best performing stocks within the S&P, only one of them is also in the Magnificent Seven. And that's maybe no surprise, NVIDIA. And that's not even the number one best performer. There's actually 2 utility stocks in the top 10. So from a price performance perspective, there are other stocks that have done well. GE is in the top 10. Talk about old school. It's just when you have that multiplier of large cap, they become large contributors. So there are opportunities that have been in the market. It's just been a tough environment for institutions that are benchmarked to these cap-weighted indexes.
So you and I may be the only people on television not talking about the presidential race right now. So let's jump to that real quickly. You have an interesting point to make when it comes to how much investors should worry about what's going on in Washington, what will go on in Washington. I think we even have a chart from you about that.
Yeah, so short term, it's likely to be a volatility driver. I think that's sort of the ultimate understatement, given that volatility in the market has been so low that at some point the path of least resistance becomes higher. So I do think we're likely to see some volatility as we get closer to the election. But the real way to think about elections and an impact on portfolios is that chart you showed. And we went all the way back to 1948 and looked at the growth of $10,000 invested in the beginning of 1948 and what it grew to by the end of 2023 if it was only in the market when a Republican was president. Well, that 10,000 grew to about 300,000. I'm using round numbers here. If you had only had it in the market when a Democrat was in the White House, it grew to 1.2 million. Shame on anybody that stops the analysis there and says 4 times better performance under Democrats in the White House versus Republicans, because if you had just kept the money in, this is simple buy and hold strategy, but if you just kept the money in, the $10,000 had grown to 38 million. I don't know about you, Jack. I'll take the 38 million.
I will take the 38 million every day of the week. Thank you, Liz Ann Sonders. That's great advice. It'll be hard for people to believe it over the next couple of months, but they got to stay strong. Thanks for coming on the show.
That's right. My pleasure. Thanks for having me.
Don't always believe the hype either in stocks. The market rallying this year on the AI craze, but what about the other investing plays? We'll take a look at alternatives if the big tech boom becomes a bust next. The market's surging this year on the back of big tech, which makes it a good time to look for stocks that haven't hit sky-high valuations. We're digging into it this week with our cover story. Barron spoke with our panel of investing experts to find opportunities beyond the hype. So, Andrew, it's always great to hear from this panel of veteran investors. Of all the picks, which one caught your eye first?
Well, one of them caught my eye was from Meryl Whitmer. She's a noted value investor. She's on the board of Berkshire Hathaway. Warren Buffett thinks highly of her. One of her choices is Mercedes-Benz, and she thinks the German car maker is very inexpensive, now trading for about 6 times earnings with about an 8% dividend yield. And she thinks it's worth about 50% more than where it's trading right now. Trades mostly in Germany, but you can buy U.S.-listed shares on the stock.
And that's a lot cheaper than Tesla.
Yeah.
Let's talk about Scott Black, one of our favorites. He often looks for those funky tech values on the Route 128 corridor. Now he's looking at something in the energy sector, though.
Yeah, I mean, he's a meticulous value investor, been in the game for decades. He actually likes the leading oil service company, which is SLB, formerly Schlumberger. And he sees the outlook for the company as being very good because he thinks it's going to be a long duration for oil and gas worldwide. The stock is trading at a historically cheap levels at around 13 times earnings. It's in the 40s right now. And so he thinks it's pretty attractive.
Rajiv Jain also looking the oil patch.
Yeah, I mean, he likes the European oils, which are cheaper than the big U.S. companies, Chevron and Exxon. He in particular likes Shell as well as Total. And I mean, Shell in particular has been doing well lately. It's got a very strong position in liquefied natural gas and also a service station network. And it's got a CEO that's been de-emphasizing some of their renewable bets, which have been ESG-driven. Investors love to see that.
So on the ESG positive side, Todd Alston has been looking at a couple of tech stocks that he likes. Can you tell us about those, Jacob?
One of them stood out to me was plain old Google, because Google is its search business at this point. It grows a little bit, but it's a cash cow, and you can bank on that because the AI capabilities that Alphabet has, it's able to stay really competitive. So it's going to use that cash cow and that really large stream of free cash flow to out-invest anybody in cloud, AI, anything where they want to capture growth. So Google is a company that can grow for a long time, so that the earnings growth can take the stock higher. Broadcom, Broadcom, it's selling AI chips, and it's made a bunch of acquisitions where it can make the right technology and the right chips to continue to grow.
AI is both an opportunity and a challenge for Google. We'll see what happens. Tell us about Salesforce, which he also likes.
Yeah, Salesforce, the stock is starting to stabilize from a big fall in the last few months. The market's concerned about decelerating revenue growth to the high single digits. But Alston pretty much says that doesn't need to be a concern, because when you look at the products that Salesforce can add to its existing customers, their AI products, Salesforce is still really good at making those. They are going to come with higher prices because they're really productive for the customers. You can drive sales growth, you can drive earnings growth and margin expansion. At some point, there will be some price to buy Salesforce.
Yeah, I'm a little skeptical on the Salesforce story. I mean, the stock is trading for about 35 times earnings. If you use a earnings number which excludes all the stock-based compensation that they basically strip out, so I'd be a little bit cautious on it.
Yeah, and the way I look at that is that what's the flip side of doing a lot of stock-based compensation is that you're conserving cash. So Salesforce has tons of cash now, and as a percent of its $252 billion market cap, it's 8% cash. When you compare that to Adobe and Microsoft, they're like 2 or 3% cash percent of the market cap. So Salesforce may not be getting full credit for how high quality it is.
Andrew, keeping Silicon Valley honest on those stock options for years. Let's go to a somewhat less sexy sector. Rebecca, Mario Gabelli liking Campbell's soup.
Yeah, I guess you don't like soup, plain old soup, right? Yeah, Mario Gabelli picked Campbell's soup. It has been a real laggard, but investors and analysts right now are really looking at a deal it did last year, an acquisition to really drive some of the growth going forward. They acquired the brand, the portfolio of brands, Sovos brands. They have Rao's, a few others. But Rao's, known for its tomato sauce and very exclusive uptown Manhattan restaurant, that is looked at as a real potential for driving growth for Campbell's. Rao's even has its own kind of soup now. JP Morgan analysts just in the last week upgraded Campbell's soup for, as our colleague Jack Howe pointed out, the first time in 15 years.
Wow.
They upgraded Campbell's on this deal, noting that it was, a real potential, for growth going forward. The CEO of Campbell's just said last month that he sees Sovos, and in particular Rao's, as one of the most exciting growth stories. Says he can see it looking like a $1 billion brand. We'll see if that plays out, but that's seen as the real growth driver.
I mean, Rao's, the restaurant up in East Harlem, is one of the most exclusive restaurants in Manhattan. It's almost impossible to get a table. They don't take reservations, only about a dozen tables. But I understand you actually got in there.
I did. I got a guy, and I know a guy, and best calamari I've ever had, and I want to go back. We should go after this.
If
Sounds good.
they let us in.
I heard they didn't even let Warren Buffett in there. So the rumor is.
That's the lore.
Thanks, guys. Jacob and Rebecca have a pair of investment ideas, and Andrew breaks down the Paramount Skydance deal. So stay right there. Andrew, it feels like the sale of Paramount has gone on as long as Guiding Light ran on CBS. Is this soap opera finally over?
Well, I mean, it may be, and Paramount's a legacy media company, CBS, Paramount, some MTV, and Sherry Redstone, the controlling shareholder of Paramount's, kind of wanted out for a while, and she and Paramount reached a deal with Skydance Media, which is run by David Ellison, who's the son of Oracle billionaire Larry Ellison this past week. And the deal looks good for Redstone and her company, National Amusements, which is the controlling shareholder, but less good for the public shareholders.
So Larry Ellison, child of a billionaire, do you think he actually has the chops to run any business, much less a business in a very tough sector?
I mean, it's going to be a tall order for him. I mean, Skydance is a tiny fraction the size of Paramount, and Paramount has bedeviled other managers in the past, and so it'll be interesting to see whether he can make this thing work. The investors, Wall Street is kind of skeptical about how well this deal is going to work. The Paramount public shareholders are getting $15 a share for about half their stock. The stock's now trading around 11. The Redstones, we don't know what they got, but they may have got as much as $30 a share for their stock. So it looks like a real disparity there. There could be lawsuits down in Delaware where the company's based, and that could potentially derail this deal.
Barry Diller's waiting in the wings.
Yeah.
All right, thanks, guys. Let's go to actionable ideas. Jacob, you're calling for pizza.
Domino's is a rare restaurant company right now that is doing it right. There's a lot of inflation. Consumers are getting very choosy about what they buy. But Domino's is able to add thousands of restaurant locations throughout the world every year, and that's a major part of their growth. They have a strategy where it's called the More strategy, and they are making sure when you do that, these stores are going to be successful, and the same-store sales growth is going to be mild there. What they're doing is when I get a pizza from Domino's, it is hot every time, but not too hot, and the delivery times are consistent. So you're talking about sales growth, earnings growth, and it's like a quasi-growth stock.
The More strategy. Why didn't I think of that? Rebecca, what do you have for us?
So John Rogers has picked Mattel. It's been a real laggard. It's down about 22% in the last year, while the market's at record high. But there are some catalysts. The CFO said just last month at a conference that he reiterated full-year sales guidance, and that made investors happy. And he also sees growth on earnings and revenue into 2025, off of a low base after the big blowout, after Barbie. But can look good.
Right, John Rogers, longtime value investor, Ariel Investments, also on the Roundtable. Thanks, guys. To read more, check out this week's edition at Barrons.com. Don't forget to follow us on X, that's at Barrons Online, and on Facebook and Instagram for the latest show updates. That's all for us. See you next week on